Tax loss harvesting is in a taxable account where you sell a stock for a loss using those losses to then offset other gains in your portfolio. So the key thing to remember is tax loss harvesting can reduce your taxes by using your stock losses to first offset your gains. And then if you have more losses than you have gains to offset, it can then reduce your ordinary income by up to $3,000 per year. And if you have even more losses than you have gains, and after that $3,000, it then carries forward into future years. The important caveat there is it's not really a free lunch. The important thing to remember is when you're selling a stock for a loss, let's assume like a normal tax loss harvesting strategy, you're already in an index fund and it has a loss and you're wanting to sell that and buy a very similar fund that's not identical, because if you buy an identical one, then you'll have a wash sale. So you're buying a similar one, staying in the position. But remember, when you're selling that loss, you're now buying back a similar stock at that same diversification at a lower cost basis. So when you do eventually sell that new position, the amount of gains that you're going to have are going to be similar to what you just sold off, you harvested. So think about tax loss harvesting overall more as a tax deferral strategy and not this fully magical thing where the taxes get deleted. But it's very important to remember it's not eliminating it unless you're planning on dying and having your heirs inherit the stock. If that's the case, then maybe it is eliminating. But for most people that plan on using these assets, whether in retirement or at any point, it's more of a tax deferral, which again, a tax deferral itself is valuable.